Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 61 of the Capital Mind podcast. In today's episode, we look at the concept of adjusted earnings. I first remember hearing of this term when I came across community adjusted EBITDA from WeWork, I think several years ago. But recently, some public companies in India also came out with their own versions of adjusted earnings, and this really caught our attention. So do listen in to understand why adjusted earnings as a concept concerns Deepak this much, and what you need to do and look out for the next time one of your portfolio companies publishes adjusted figures. Deepak, we're doing this episode partly as an intervention and partly out of my own curiosity. I think last week you went to town on Twitter after certain companies had released earnings which were adjusted earnings and adjusted in many ways. And I think you made way too many jokes about it on Twitter that evening. But I mean, jokes apart, what really interested us is this really seems to have got your goat in that sense. You're not approving of this practice whatsoever and have called it out quite harshly. So I actually wanted to just dive into that. And maybe let me just start with my first question. So what's the big deal if I adjust or am adjusting the books of accounts? I'm not hiding the original ones. Those are still disclosed. This is just additional information. So can I say more information is better than less information? What's the problem here?
In fact, it's a great starting point. Shray, I'll tell you, let's go back to where it began. The problem in an accounting system is that it doesn't accurately reflect anything. And I'll give you multiple reasons. Let's say you were in a business which you said only the money that I actually receive in my hand is money I have, and anything I haven't yet received or I have to pay but I haven't yet paid is not happening until it is actually done. So if I have 100 rupees in my hand, that's 100 rupees that I own, and period. It doesn't matter that I have to pay someone 200. So the money will go out in a couple of months. I only care about what I have today. This is called cash accounting, and cash accounting is what governments all over the world follow. The problem with this approach is that it doesn't accurately reflect payables and receivables like you can imagine. And therefore, governments, for instance, if a government has a debt payment coming up, or if it has, for instance, it has revenue that's going to come but has not yet come, like the Vodafone has to make a big payment to the government. It hasn't yet made it. The government doesn't put it on its books saying, oh, this is revenue we've earned. They record the revenue only after they've been paid. Works for governments, and governments worldwide do this. But it doesn't work for businesses, because businesses can say, listen, I'm giving you something over 6 months and I finished 3 months of this. You have a contract with me, a legal contract that says you have to pay me if when I deliver the entire project to you. So out of 6 months, if I've done 3 months, I'm supposed to record 50% of whatever you're supposed to pay me as revenue. So if you are paying me 100,000 rupees, then 50,000 rupees is my revenue for 3 months, and I have to recognize that. Now, there's a good reason for it. You have receivables and you have payables. You have invoiced someone. You have not yet received the money that is supposed to be money that you're going to. You should record it as if it's money that you've gotten. To the extent that even the income tax department asks you for this and says, listen, if you've invoiced it, then it's yours. The fact that you haven't received the money is your problem. You pay us the tax on it anyway. So you might actually pay tax on receivables. We'll come to that later. But now you've gone from cash to a little bit of haziness, right? That haziness is, I am telling you I have this money, but I don't actually have this money. That's called accrual accounting, saying I'll record the revenues as they accrue, but not until the payments are made. The payments could be made in a different fashion.
Or in theory, you could get it up front, but you can't recognize all of it.
Which is another interesting example, because if you get paid up front for something, for anything, you cannot recognize that as revenue for yourself, even if you don't pay. I'll come to examples of that. But, when any business now records its revenue and shows it to people, they give you 3 statements. They give you a balance sheet, which is what you have and what you owe. a P&L statement, which is what you make versus what you spend, and a cash flow statement, which is what you actually have in the bank versus what, for instance, if I have revenues of 100 crores and I have in my balance sheet receivables of 80 crores. That means, assuming I started from zero, I actually built 100 crores, I received only 20 crores in my bank account. The remaining 80 crores is in the air. I haven't received it yet. So the cash flow statement will show me 20 crores. The balance sheet will show me 80 crores sitting in assets, which is as a trade receivable, and 20 crores sitting in cash. And the P&L account will show me a revenue of 100 crores. That's how the statement kind of goes. Now, if it's a cash accounting business, then the cash flow statement would be the only statement you would care about. That just all the details over there would matter. But then you get very interesting rules on top of this in terms of revenue. Like, for instance, you said like Capital Mind may have a subscription model. The subscription model may say you can subscribe to Capital Mind for a year. If you do that, you pay some amount, say 20,000 rupees. Over a year, 20,000 divided by 12. Every month I have to recognize that much as revenue. So every quarter I have to recognize 5,000 rupees as revenue. So that 5,000 rupees is recognized when a person finishes 3 months. So if the end of the quarter, the person has finished only, let us say, 1.5 months, I can only recognize 2,500 rupees. So you have to make these rules. Why is that? Because, okay, it's possible that, say, there's a company that like New York Times, which has no refunds at all. So even if you cancel a subscription, you're not going to get any money back. Still, they're not allowed to recognize the revenue upfront. They're required to amortize it over the course of the subscription simply because of accounting rules. Now, this is where it gets interesting. I've already told you that there's stuff that is cash, the stuff that's accrual. Accrual is something sitting on top, which has some, it's adjustments in the sense, it's because I could bill a person 1,000 crores and then he could say, oh, you know what? I'm sorry, I don't have the money. And 2 years later, I can say, oh, I'm sorry, he didn't have the money, so I'm going to take a loss of 1,000 crores. So I had revenues of 1,000 and loss of 1,000 crores 2 years later, and that would be perfectly fine by the accounting departments. But the idea here becomes if that's an adjustment in some sort of way, can we not adjust accounts for other reasons? Because I'm telling you, listen, I have this money, but I'm not supposed to repay. I'm not going to repay it. So I'm going to record that as revenue. A very famous education company tried that. We'll come to that. There's a very interesting example of how that.
As long as you don't name names, we can talk about it.
Yes. So, this is where it's interesting. There are then these adjustments sometimes are actually valid. I'll give you one example is, of course, the fact that you have a subscription. It has to be amortized over the period of a year. You also have construction. Now, this is where it becomes complex because I think one of the reasons why I look at real estate companies and real estate balance sheets and things are very wonky there nowadays because everything is an adjustment. The actual fundamental rules have changed to becoming adjustments. When you build a project, they say, well, you know what? Amortize it according to the time you'll take to the project. So you may take 11 months and then that in the 11 months, for every month, do 1/11th of that project cost or project revenues as well as according. So, but what I have realized is that in the last 20% of the time, you will spend 40% of the money because it takes some time to bring the building up. But then the last 20% of the time, you're going to do the interiors. And interiors are where the maximum cost is. It's going to cost you to get granite and tiles and stuff for the wiring and for the plumbing and for the taps and for the bathrooms and so on. So by the time you figured this out, if you're looking at a straight lining of a project saying for every month I will do X, the last 20% of the project, if it takes 40% of the cost and you receive revenues also through the project because people are paying you, shouldn't you recognize it according to the way you're spending the money rather than the actual time spent on it? In the sense of the actual spends on a project should, instead of amortizing it over a 12-month period, I'll amortize it according to the actual amount of spend. This becomes complicated because as a person observing a real estate project, I want to know how many of your projects are in that last 20% phase because I know that's where the maximum money is going to be spent. And that's when you might have a cash crunch, you might have other issues and so on. So if a real estate company wanted to do a valid adjustment, it would actually adjust its revenues for this. So saying, oh, listen, you know what? The accounts require us to do straight lining, but I'm going to do a slightly different thing which reflects my actual cash flows rather than, something like this. Of course, that doesn't happen because real estate companies just do whatever is exciting to, you. But that would be a valid adjustment. Take a bunch of things. I mean, no one really cares when things are fine. It almost never matters to you or to me, or in fact, the company itself. Because if you're making profits, they'll announce that we're making profits. It's suddenly when we're not making profits, how can we adjust our results and therefore show you that, what, we are making profits. To give you an example, I mean, one of the oldest things that I remember seeing was something around America Online, AOL in the US, which used to send CDs along with magazines that you used to buy or cups or whatever else. So the idea was that you take the CD, you'd install it on your computer, and whatever you installed, that would dial up into this AOL and give you a trial membership. That trial membership would then eventually convert to a real membership, and then, boom. So they spend a lot of money doing these CDs and distribution of those CDs. They'd partner with magazines, they'd send CDs directly to your houses, they'd buy addresses and so on. There was a huge cost to this operation, right? Now, typically, if you're thinking like, the traditional accountant, you're saying, boss, if I spend 100 crores on sending money to CDs to people, 100 crores my expense for the year. That's how much I've spent. But what AOL did was it said, listen, no, 100 crores. You know what? If I give a person a CD, he might use it now, but he might find this CD in his attic 2 years later, or as much as 3 years later, and install them. So he said that a life of this concept is long. It's about 3 years. So therefore, instead of taking the 100 crores I spent today as a 100 crore expense today itself, I will take only 33 crores today. And the remaining 66, I will take over the next 3 months. This, I think, is where the adjustment comes in. So they say, oh, well, you know what? We've not done this. Of course, at that time, because the accountants allowed it, it was actually in the accounts. So how did people find this out? And there was a conference call in which they said, you're amortizing this stuff over 3 years. And obviously you're tracking who's installing what, and therefore who's converting from trial to full. How many users have you found that installed a software that was on a CD as much as 3 years ago and now became a member? That would tell me that the useful life is 3 years, right? They said 0. So we said, 2 years is 0. It's 1 year. So the useful life is 1 year. Therefore, you have to expense all of it in the same year. AOL had to go back, restate all its accounts because of this. Show a massive loss or a massive one-time loss. And as an aside, the markets actually rewarded them at the time. This was 1999. And they said, oh, well, you know what? They've come clean. So they should be, now they're going to be good people now. So they got rewarded for this exercise. But of course, later AOL's price fell 90%. We'll leave that for a different discussion. But the accounting shenanigan was part of what they did. And eventually, a lot of other companies, even in India, have tried to adopt the same thing. They just capitalize certain expenses that should be operational expenses. And therefore, and we'll come to that because I think that's one of the key parts of this adjustment part of the transaction.
Okay, well, the AOL example is a bit ancient, so maybe many of our listeners today don't know what's going on or who you're talking about. But I think the point you make is relatively broader. So let me take a more recent example. I know startups, for instance, often talk of things like contribution margin and so on. And the argument they make, which I at least find persuasive, is, look, the headline number isn't useful because there's too much loss or it's the early days of the business. It's too confusing. If you start looking at this thing as contribution margin, you can actually build a financial model which helps you understand what's really going on. Otherwise, you'll just look at this number of minus so many hundreds or so many thousands of crores and say, sorry, why would I ever invest in this? And at least that has an intuitive appeal to me, right? I understand the economics of your business. I see how it actually grows. And I'm like, oh, even though it's disguised by this heavy, headline number, actually the business is underlyingly great. Does that appeal to you as an argument? And that is why we need to do these adjustments to explain all this to people.
This is actually interesting because we have to go back to the history of why contribution margin was important in the first place. Let's say you put up a factory and this factory makes a widget. That widget you sell at 1,000 rupees each, right? So you build up this factory. It costs you 100 crores to build up this factory. And you put all this 100 crores from your pocket, just as an example. This 100 crores was spent, and the first year you could only sell 1,000 widgets, and you sold it at them at 1,000 rupees a piece. Now you're saying that my revenue is 10 lakh rupees. Is my cost 100 crores? The answer is no, of course not. You can't take that 100 crores and try to apply it on 1,000. The capacity of this business is going to be like 1 million widgets per month. Why would you take only 1,000 widgets and apply all the 100 crores of cost on it in the first place? But the answer to that is also not try to slice out that 100 crores in any meaningful way. Keep the 100 crores aside. It's a fixed cost that you already spent. But what does it take for you to make that widget? There's some raw material cost, maybe 150 rupees. There may be labor cost, that's another 125 rupees. So you add all this up, and maybe 400 rupees is how much your cost of manufacturing that particular widget is, which essentially means to sell something for 1,000 rupees, it took me 400 rupees to manufacture it, and maybe another 200 rupees to ship it, transport it to some other place, whether this thing. So my effective cost for this item was 600 rupees. And all of this is variable cost in the sense that if I have to manufacture one more widget, it's going to cost me another 600 rupees to manufacture it, two more widgets and so on. So my contribution margin therefore is 400 rupees per widget. This contribution margin initially starts off being negative. Why? Because if I get a worker and that worker charges me 25,000 rupees, he should be able to create, maybe 100 widgets a month. Right, but my factory is not yet fully ready and all that stuff. So I'm paying him a salary, but he's only able to manufacture 10 widgets. So instead of his salary being amortized over 100 widgets, it's being amortized over 10. Therefore, on a per widget basis, his expense is very high. It's negative contribution margin for me. But once he starts making 100 widgets, then I know that, listen, at 100 widgets, I'm profitable at contribution level because now I'm, at this thing. So you think of things above the line and below the line, because at this point, you're probably thinking, listen, this guy doesn't manufacture things by himself. He uses machines, he's got a manager, he's got a CXO, he's got an HR person, he's got some guy who guards the door. How are those people accounted for? The answer to that is, well, you know what? Senior management salaries are not part of contribution margin because senior management salaries are going to be amortized across everything. So why don't we do this? Why don't we call that a different thing? Let's call it EBITDA, for instance. Just say that there are fixed costs which go below the line and above the line being a place where you kind of calculate the contribution margin. Above the line are only variable costs, below the line are fixed costs. So anything that's management salaries and rent and all that stuff, that does not go into contribution margin. Contribution margin is strictly the cost of what you need to produce those. So you first get healthy on the contribution margin and then get healthy on everything else. So you get healthy on EBITDA and so on. This is where it gets complex because today everything has moved to tech, right? So what was the traditional concept of technology? Technology was, I need a server to store all the data. You know what? This is a fixed cost because once I get a server, I'm going to keep everything in that server. And whenever I get new orders, I'm going to just keep putting this thing into the server and so on. So it was a fixed cost. It was always below the line. It never affected contribution margin. Take a food delivery business today. It needs servers just to be able to deliver the goods. So there will be a part of this server cost which is not fixed. It is more like, listen, for every new order, I am going to need either another server or
some point, whatever, 000.
So maybe for 100,000 orders, I'm going to need one more server. So if there's a server cost of 100,000 rupees a month, then that 1 rupee per order is contribution margin, contribution cost, right? So it should be deducted from contribution cost. But it is, because of the traditional accounting, they move stuff into saying, this is server cost. This is not part of contribution margin. So at the contribution level, you look positive. But in order to make that contribution, you're going to need the servers. So if I look at it as a business person, I'm like, dude, that is not contribution. This is bloody, I'm negative at contribution because my server cost is just too high in that stuff. So you're hiding some fixed costs, hiding some costs as fixed costs, which are actually variable costs, and you're showing me a better return in that context. If you were looking at this from a traditional business perspective, you actually have the contribution margin figure does not actually tell me how much the real contribution margin of this business is. Now, take the same customer, the delivery service business. There is a certain set of dynamics that works. This business has 10,000 crores of cash. This business generates, I don't know, maybe 200 crores or 150 crores per quarter in just interest costs because it's received. So if it shows you revenues of 500 crores, 350 crores comes from the business, 150 crores comes from interest on money on the bank. So it's not really, contribution. It's not really operational revenue. So you got this revenue. What if they told you, Shray, that I have made a 350 crores in losses? You're mentally saying you made 350 crores in losses. So you know what? You got 150 crores for free from the cash that you had in the bank. Therefore, you actually made 500 crores of losses and then brought it down to 350 because 150 you got from all the cash balances that you had, right? So the actual loss is a much higher number. And then, for instance, you could say that your losses are 350 crores, but out of that 200 crores is depreciation for some equipment that you had bought long back. Now depreciation is a non-cash expense. You spend it in some other quarter. You're just going to amortize it now over a period of time. So in that sense, 200 crores of cash has not left your bank account. It had already left your bank account a long time back. So in a way, that 200 crores is not a cash outflow. An ESOP is not a cash outflow because in ESOP cost is just an accounting cost of ESOPs and so on. So now you've got a lot of adjustments that you have to do in order to get to understand yaar, the business mein tune kitna spend kiya, how much did you spend in the business itself and how much do you earn in the business. And then you get things like gross merchandise value. That's what they tell you gross merchandise value is. Now, if you look at gross merchandise value, it should be just sum total of all the orders that were entered into the system. Multiplied by something. What if I told you that they distort these numbers as well? So the adjusted revenue is, what if I had charged all my items at MRP? And my order values, I never charge at MRP because I get a 30% discount, and otherwise why would people come to me to buy at MRP? Come on, I'm an online guy, right? But I charge 30% discount from MRP. But you know what? For the gross merchandise value, I will tell you MRP. So if effectively you're giving me roughly 50% higher. So where you've sold for 70 rupees, you're actually showing me 100 rupees as an MRP. And that is my gross merchandise value. I'm supposed to now get very happy with that figure. So tomorrow you could just keep selling higher MRP products on which you're giving higher discounts and actually earning lesser and lesser money, but the order value is growing higher and higher and higher simply because you're showing me MRP. So this is again, distorted, can be dangerous. And the clear concept over here is adjustments. When they happen, these distortions that come to place, you need a lot more information just to decode what they've adjusted for.
Okay, and I'm so glad you ended on that note because I fully do take your points. But I'll go back to the spirit of my first question, which is, it's not like I'm hiding the real numbers, right? These are just additional information. So if you're not happy with them, can you just ignore it? Why are you taking my case?
This is a great question, and I think the default assumption when you go to an earnings call, and this is worldwide perhaps, is that the management wants to produce a rosy picture for you. They won't tell you that the company is doing really well. And one of the reasons why accounting standards were created was because you wanted everybody to work in a standardized format. An accounting standard is how you can recognize revenue in certain cases, how you can recognize expenses in certain cases. The recent accounting standards in India, for instance, have said, listen, if you take a building on a lease for 5 years, the lease has a inbuilt 10% increase per year component. You can't just say I paid 100 this year, 110 next year, 125, whatever, something year after. You have to calculate a concept of depreciation which says, oh, you know what, it's 100, 110, 125, you got to discount that cash flow to current and then straight line it across 5 years. So effectively, it could be that even though I'm paying out 100 rupees of rent per year today, I'm going to have to show 107 rupees of rent as my effective amortized payment. But here's the best thing. It doesn't come into my balance sheet as a cost above the line. It comes into my profit and loss or a statement that says this is actually a lease liability. It's part of my debt profile. So because it is a contracted thing that I have to pay regardless. So I end up with a situation where now a zero debt company has debt. and a zero debt company has a lease liability, and that lease liability amortizes over a period of time. So it's complex, but it sounds like depreciation rather than rent. But this accounting standard was invented because people had these wonky rent arrangements which increased rents at dramatic values towards the end. So to fix that, the accounting people have gone in and said, no, we're not. So, I mean, it's usually, accounting standards sometimes are, using hammers to kill mosquitoes. So you might get the mosquito, but you'll destroy a lot more in the bargain, right? But so a lot of accounting standards is just that. But when you start noting stuff that are not in the standard or not per the standards, then it gets confusing. So, for instance, if I have a lot of server cost and I include maybe 10% of that server cost in my contribution margin, the remaining 90 isn't. In that server cost also, I decide to capitalize a bit, saying, oh, we're building a product. So that product cost is, I've spent, let's say, 55 crores on servers, but 40 crores is actually to build a product, and only 25 or 15 crores is to actually run the business. So I'll take 15 crores as an expense this year. I'll amortize the 40 crores over the next 3 or 4 years. This suddenly becomes a gray area, because you're not telling me why that differential was between 40 and 55. You're just telling me that it's 40 and 55. I don't know how it works. And there is a lot of discretion. And more importantly, the management knows a lot more about the company than you do. So when they start giving you rosy pictures, that rosy picture can both hide from you the real things that are happening inside of the business. And for instance, they're actually telling you when they're adjusting the EBITDA that, listen, I know that I'm supposed to report to you X. Ignore that X. I'm actually doing 2X somewhere else. At this point, I have to question, saying, listen, those accounting standards exist for a reason, for whatever it is. Why does your expense not meet that requirement? And often you don't have the leeway to ask this question, because they just give you the word adjusted EBITDA, adjusted revenue. You almost, like somebody said, my daughter thought that the company's name was adjusted because everything was adjusted something and adjusted something else. That's where we are.
That's fair. Now, before we hit record, you actually, and I think I get the spirit of where you're going, which is, given the information asymmetry, in many cases, could I even call it the power asymmetry because of the dynamics during, say, earnings calls and all. The fact of the matter is that there is marketing you can do, but maybe that marketing shouldn't be on earnings. That marketing should be on the company and its prospects and explaining the business model and so on. But don't go around adjusting stuff. But I'm actually drawn to a bunch of examples you shared, and I've written them down so we can actually go through them one by one. About using, I think this is still in accordance with accounting standards, but at least how people have pushed things to the very edge and either adjusted or not adjusted. So these are 4 examples. Creatively using affiliates, creatively using checks or post-dated checks perhaps, being very selective about how you account for ESOPs, and GMV, which you've kind of already hinted about already, but I think there's more to it. Do you think you could just do a quick description of how people have, should I call it, manipulated or even borderline abused each of these tools to change how things work?
Yes, and I'll name some companies, I won't name the others. Interesting part is, see, some part of this I think is good in the sense that a finance company is only required to tell you how much interest it earns. But if you're looking at a finance company, you want to know from the finance company, listen, what have you charged interest on? Is it a gold loan? Is it a secured loan, unsecured? Is it a short-term loan, long-term loan? Is it to an individual? Is it to an SME? Is it to a builder? Is it against housing? So they disaggregate their numbers and tell you, listen, I've had so much lending on housing, so much lending on something else. So each lending company actually gives you these disaggregated details. To a certain extent, this is desirable simply because you need to know more about the business, and the management is the only one who has this information. You can trust them and say, listen, I know you've given me the headline number, but please break it down into meaningful things. What if, for instance, a food delivery business itself could say, listen, I make 40% of my revenue from Bangalore, 30% from Bombay, and 20% from a small town in Gujarat. This is anti-competitive for you, because the minute your competition knows that there's a small place in Gujarat that's yielding 20% of this massive company's revenue, they will put their people out there, they will fight it out, and get. So maybe they're not present in that city, they're present in Bombay and Bangalore, and they suddenly see, oh, these guys are the only guys in that city, let me come. So they may not reveal information simply because it is for competitive reasons. Let's look instead at some of the other parts of the creative part of the accounting process. So, like you said, there are subsidiaries, which there are so many shenanigans in subsidiaries. I won't go there, but I'll give you an example of how complex one business was. It was not complex. Also, it was well known. This was a company called DLF. We know about it. Now, DLF is a real estate company in the sense it makes buildings. Some of them are residential, some of them are commercial. Now, you don't usually sell a commercial building. You just hold a commercial building and rent it out to your commercial people, and they give you rents. You earn the money as rents. Instead, what DLF used to do was sell its commercial real estate to a company called DLF Assets. DLF Assets was not owned by DLF, but it was owned by the promoter of DLF. The promoter of DLF had a sister company called DLF Assets. That DLF Assets would then rent it out to corporates, earn the rents. And so the way the structure would work was like this. I built a building. I spent 1,000 crores on this building. The market price of this building is 1,000 crores. DLF Assets, please buy it. DLF, the listed entity, now would recognize 1,000 crores of revenue. Fabulous. You're thinking, what's wrong with that? The promoter's company is paying this 1,000 crores to DLF. What's the problem? The problem is he wasn't paying any money. He was just saying, it's a payable. I will pay you. And the DLF company itself was saying, yes, you must pay me. But there was no actual money transferring hands. And when there was no money actually transferring hands, the receivables of DLF kept bloating upwards and the payables of DLF Assets kept bloating upwards. But DLF Assets was a private unlisted company. It was supposed to get listed in Singapore, and therefore they would use the IPO money to repay all of this and all that stuff. Come 2008, 2009, the whole market collapsed everywhere in the world, and therefore you ended up with a situation where DLF Assets could not be listed and could not pay. So by this time, you had multiple 1,000 crores of receivables sitting on DLF's book, on which DLF has actually paid taxes, and DLF is a listed entity. Because once you say it's a receivable, you have to pay tax. You've paid taxes on it, you paid whatever and all that stuff. And the DLF company, DLF Assets company is not paying up. They don't have the money, but they're making rents, but they're not paying up. Now you sit there and say, what's going to happen now? So DLF's promoter merges DLF Assets into DLF itself. So effectively, the two companies become one big giant entity, and the receivable payable is cancelled. So now what happens? A massive loss is shown. DLF went all the way to 1,000 rupees at that time per share. And even now in 2023, this is 2007, in 2023, it trades at a fraction of that price. I'm talking about less than 50% of that price, having lost at one point 90% from the peak as well. One of the reasons for that is once these things happened, you suddenly realize that, listen, if I keep making commercial buildings, I had DLF Assets to sell it to, so I could keep showing my revenue increasing. If I don't have DLF Assets to sell it to, it's part of my own company, I don't have that income. So why would I even bother building commercial buildings if I'm not going to be able to show revenue on it? And only the rentals will come, and the rentals could take, 6 months, 8 months, 12 months, and, it'll ruin my entire dynamics. You end up with this as a shareholder saying, what the hell was going on? If this was the real business, why wasn't it? And to be fair, they were told about it. It was part of the key risks, saying we deal with this promoter entity, you guys should know, and all of that stuff. So everybody, in the market knew about it, and yet traded up DLF at the time saying, it was great. It's not illegal. It's just that it was an element that was shown to you. And like you've said, why don't we show it? The problem is sometimes even if you show it, people aren't willing to, see it both in the positive and negative light. But when you have a big receivable, and in fact, when your increase in receivables is roughly equal to the increase in revenues, the company is not making any money. There's only one exception: if the company is doing work with the government. So to avoid this, the government is doing something very fantastic. So if you look at some of the government-owned shipbuilding companies, you'll suddenly see they have some 8,000 crores of cash. So I'm like, what? Why do they have 8,000 crores of cash? And then I look at so that's their assets, right? So I look at the liabilities. There's a other liabilities item of about 7,000 crores. So I'm like, what's the hell? Why do you have an other liability of 7,000 crores? And this is a business whose market cap is like 10,000 crores. Okay, so these numbers are very large. So when you look at that, you kind of wonder and ask the question, do you know what the government has said? Listen, I know if I don't pay you, your accounts will suck. So why don't I pay you 8,000 crores in advance? And you finish your ship It's going to cost you 7,000 crores to build. And when you give it to us, then whatever's left is your profit. Right? So it's a liability of 7,000 crores and a cash of 8,000 crores that's sitting on their balance. They've been paid in advance. Of course, this is a rarity, but that I think is largely one area where the big receivable problem was sorted by making advance payments. Otherwise, big receivables are very standard in the industry.
So that's around subsidiaries and payables. Can we talk about checks?
Oh, yeah, of course. In fact, I think before this we were discussing something, but we won't discuss, we'll discuss it without naming names. Assume a company has 4,800 crores of cash that's sitting on its balance sheet. And then it tells you it has 4,800 crores of cash, and you're looking at it, this is fantastic. This is a great company. It has 4,800 crores of cash, except there's a star in the bottom. That star says, we have 4,800 crores of cash, but this includes 4,600 crores of checks, which were realized after the balance sheet date. Now, checks are realized in one day. So that can only mean that the balance sheet date was March 31st, because that's the annual report. Somebody has gone and deposited a check of 4,600 crores on March 31st so that it can get cleared on April 1st. Now, who does this? Plus who uses checks and all of that stuff? You end up with this situation where the revenue simply isn't real. In the sense that, let me go back a little bit. There are lots of reasons why checks are used. It's a negotiable instrument, so you can always, you can use it. So what you could do with a shenanigan like this is simply say that I have the money when I don't. I could deposit the check and say I got the check. And if the check bounces the next day, I don't have to report on it till the next date, on which case I can go and present the check again on the end of the quarter date. And again, it could bounce the next day. And you could keep having that happen, and shareholders won't even realize that this guy is just depositing a stupid check, and it's not working for them. Trucking companies, truck finance companies in India, certain truck finance companies were doing this. They would take post-dated checks from a customer. And in order to, so the interesting part was that if you had to declare an NPA, that NPA would have to be declared from 90 days from the end of the quarter that the truck was financed in. So if my payment date was May 15th, I got from June 30th, which is the end of the quarter, I got another 90 days to declare it as an NPA. So what would happen is on September 30th, now the guy is not paid up, you go and present the check saying, listen, we're going to present the check on September 30th. The check would bounce on October 1st, October 2nd. So as of the balance sheet date, you've gotten paid. Except it's bounced 2 days later. And you could basically drag an NPA for 6 months instead of 3 months. In fact, 6 months from the end of the quarter, so it's even more. So RBI now has cut that game down and said, you can't do this. You have to realize the money, otherwise call it an NPA. If you haven't realized it, I don't care. And it has to be 90 days from the date of payment he was required to make. It's not this end of the quarter business. And so there's no ambiguity over there. So a lot of NBFCs have had to curtail this practice since. This check concept, whenever you hear checks being presented on a balance sheet date and all that stuff, your ears should perk up, because you will find that checks are being used innovatively to show you cash that doesn't exist.
This one actually intuitively I've seen in my personal life as well. The last two, ESOP costs not being properly recognized. Could you talk about this briefly? I know this comes up a lot in US tech companies where it seems that accounting standards don't. I heard this in Odd Lots or something, where you're not required to count ESOP cost in your reported P&L, but they do account for it in the tax P&L and so on. So.
Oh, yeah. So, one of the biggest problems in ESOPs is how do you account for them? So, for instance, if Capital Mind is worth 200 rupees a share, and I issue shares to ESOPs to, everybody, all employees get ESOPs at 200 rupees per share, perfectly fine. There's no loss because the company was worth 200. I gave it to them at 200. The idea being, if I wanted to raise external capital, I would have been able to raise it at 200 rupees per share. What if I gave people shares at 10 rupees per share? Now, there is a cost to the company of 190 rupees per share. The accounting standard says that as you get closer to vesting, because the vesting period could be, say, okay, there are 100 shares that are being given to you, but 10 shares a quarter for 10 quarters. That means every quarter the company is losing 190 rupees per share into 10 shares, so 1,900 rupees per quarter for the next 10 quarters.
Just technically, you'll probably use Black-Scholes, so it'll be a little higher than 190 rupees.
Yeah,
But I take your point.
Yes. So you would have this optionality thing in place and all that stuff. The downside, the problem with this approach, and this is one of the approaches that is this thing is that ESOPs are actually not a cost, in the sense company's not paying anything, and chances are Capital Mind, if it try to sell its shares, it may not be able to sell at 200. It may be able to get 500, or it may be able to get 200, 100. You don't know the answer to that. But because the ESOPs are given at a paper valuation, you value it on paper at whatever you want, and then give the ESOPs. You can't have very wildly varying. For instance, I can't give one person ESOPs at 200, then next day go and value that company down to 10 rupees per share, and then third day value it back to 200 rupees per share. So it has to be a known valuation. What happens right now is that the ESOP costs, according to the accounting laws, what companies are saying is, listen, this is not a cost and we shall adjust it for the ESOP cost. I don't think that's fair. I think that's not fair to say that, listen, there is no cost to your ESOP, because your ESOP is effectively diluting every other shareholder. Not yet diluted. You've just vested the shares. As on each vesting date, the shareholder can effectively get diluted, but you're not diluting them yet. But there's a cost to that dilution. That cost is being shown on the balance sheet. The problem with this accounting standard is it says whatever valuation existed on the day of the granting of the ESOP, whichever day it was, that valuation persists. So if you have a valuation of a company at 10 rupees per share, and the valuation, at 200 rupees per share, and you've given the share at 10 rupees, the company knows it has 190 rupees cost per quarter for the next X quarters. However, if the company goes and lists itself and the share price falls to, 15 rupees a share, the loss is not 190 rupees, it's only 5 rupees, because at that time, if they had issued more shares, they would have got shares at 5 rupees, at 15, people buying it at 15 rupees. So is the answer that we should not allow that cost to be frozen at the day of this thing? But then it works the other way as well. So if the company listed and it went from 200 to 500 rupees a share, then on that vesting date, the cost is actually 500 rupees minus whatever the company is. So it's 490 rupees per share, not 190 rupees per share, which will increase the cost to the company and hurt it. So I think here having some kind of adjustment makes some sort of sense, but I don't think the adjustment is don't adjust at all, or adjust for whatever value I thought it was at the time of the IPO. I think both answers are wrong. I think we need a third way to analyze all of this stuff. Problem is, of course, nobody knows this. So, not many people know this. So what happens is they either write off the ESOP cost completely and say, we'll ignore the ESOP cost completely. I'll tell you where the ESOP cost matters. And this is where it's interesting. In the US, you have companies issuing ESOPs and at the same time buying back their own shares. If I'm generating cash from the business and I'm using my cash to buy back shares at $150 per share, why is my ESOP cost not $150 per share? And that's what if I'm issuing ESOPs at the same time that I'm buying back shares from the market, the cost of that ESOP is $150 minus whatever the person pays. Maybe he pays $10. So $140 per share is a cost. It's a real cost. In India, you don't have so many companies doing, some companies are at this point doing buybacks at the same time that they're issuing ESOPs. So the cost should be linked to that. You know what the interesting thing about the Indian companies doing the buybacks at the same time are? One of these companies is the valuation of the company is 1,350 rupees per share, according to the value on the day of the grant. The current market price at which shares are being bought back is 800 rupees. So effectively, the company is actually paying lesser than the ESOP value for the same shares, but it does not get any accounting benefit. It has to show the loss as of 1,300 rupees per share. So you have this, if you're losing 300 crores on ESOPs, in my view, you're actually losing 180 crores on ESOPs. So in the sense that you have to mentally adjust downwards.
This is a counterexample to our points where sometimes adjustments could help as well, I guess.
Yes,
Yeah.
I mean, in the sense that, see, nobody tells you this. The problem is they either tell you ignore the ESOP cost completely.
Or it's the full amount, say 300 in this example, but actually there's more. Okay. We've already spoken a little bit about GMV, but could you talk a little bit about GMV and how it's been sort of adjusted or tampered with in the past?
Oh, yeah. In fact, one of the examples I was talking about was this education research business. I'll start with that and I'll go to another one. So the GMV concept, and GMV is abused in multiple ways. We've seen this in way too many cases. But one of the things that has happened recently, this particular education company, and it's famous, so but I won't name it, their auditors had some very interesting notes in their annual set of accounts. They're private, so you have to go to MCA to get this account. It's a very interesting entry in their accounting standard. So it says, well, you know what? This company makes education packages. And those education packages can be, say, 1 lakh rupees a year. Now, when I go to a parent and say, you got to buy this education plan for your kid, the guy looks at you and says, how much does it cost? If I say 1 lakh rupees, he's going to say, get the hell out of my house. Instead, I tell him it's 5,000 rupees a month for, 20 months. Now, he's looking and saying, listen, 5,000 rupees a month is affordable. You know what? 2 months, if my kid doesn't like it or doesn't adjust to it, I will only lose 10,000 rupees. So, karlo. The problem that the guys were doing was they were selling them 100,000 rupee package with a loan whose EMI was 5,000 rupees per month. So what would happen then is an NBFC would say, listen, I'll give you a loan for 1 lakh rupees. You pay. You would sign the papers thinking you're buying from this education company, but you're actually buying through this NBFC. You're actually signing up for a loan from the NBFC. This is affecting your CIBIL standards. Of course, leave all that aside. How was the revenue being accounted for at the startup? He would say, listen, the loan company, NBFC, is going to receive all its money from the 5,000 rupees per month payments. So guess what? You pay me 80,000 rupees upfront for this one. So you recover 5,000 into 20 is equal to 1 lakh rupees, but pay me 80,000 rupees upfront. Why would the NBFC pay upfront? Because they would be like, dude, this guy may default in 2 months. Let's say I am this education company. I and Shray, you're the NBFC. I say, Shray, don't worry. If they default, whatever they don't pay for, I'll pay. So you paid me 80,000. If they paid 10,000, I'll pay you 70 plus some interest and all that stuff. So don't worry about it. I will protect your interest. This is called a first loss default guarantee. And this particular education company was doing this. So the auditor looked at this and says, excuse me, you're recognizing 80,000 rupees as revenue? Yes. And if the customer doesn't pay back, you're liable to pay back the NBFC? Yes, but I don't. Why should we talk about that? No, hang on. How many such customers have already not paid back? Well, there's a bit, So, and he says, well, you know what? So it's like I couldn't hear the auditor busting a blood vessel in this room. And because he writes in the annual statements saying, guys, this company said its revenue was 2,000 crores. It is not 2,000 crores. It is 1,000 crores. Now, usually you don't find an auditor writing something like this. You find the auditor saying, the revenue is 1,000 crores. I understand. He says, no, they told us it was 2,000. We went and did all this work. And then we found out it's actually 1,000 because they had these 1,000 crores which they were supposed to pay back and, it was not really their revenue. So we subtracted it from their revenue and brought it back. So the gross merchandise value, gross selling value, whatever it was half of what. And this is as of last year. So now the new results will come. We don't know how much that's going to get readjusted by, because when those results came out, they gave us a headline number of the new year. And when the new year people asked, listen, are you serious? Because is that number audited? He said, no, it's not audited. Because when the audit happens, obviously that number is going to get, reflected backwards and stuff like that. What is interesting about this is it was not that this company was trying to do a bad thing. It was just that it was trying to tell you that it made so much business when it didn't have that kind of business. So the gross order value or gross whatever was nothing. Let's take another example of a food delivery business. Let's say it's something that they delivers, they want to tell you that the metric that you should evaluate them by is gross order value. Now I think gross order value is great. Gross order, how much have people ordered? And then in the fine print, they tell you that the gross order value includes cancelled orders. Now, in good times, this is fine because cancelled orders are maybe 5% or 2%. I don't know, but you're assuming. When times start getting bad, is it like to keep the metrics, you get people to order and cancel, so that your gross order value remains the same? Anyway, you're making truckloads of losses, nobody cares. So the issue is then that gross order value is growing at 30%. You can actually tell customers, forget my losses, look at my gross order value. It's like at this point, the gross order value, if it includes cancelled orders, should also say how much percentage of your orders were cancelled. Otherwise, it doesn't make any sense. Let's say a service was selling 20% below. It could be a medical. So medicines, for instance, are usually sold at MRP, but some of the startups in India sell at below MRP. What if they told you that the gross order value that they have is only the MRP? But like I told you, people are not going to come to that startup to buy at MRP because I can go to my local shop and get it. Instead, they're going to say, listen, I'll come to you because I'm getting a 30% discount on the MRP. So if your order value is 1,000 rupees, the MRP is 1,000 rupees, the actual order value is 700 rupees. But they tell you that the gross order value is 1,000 rupees. That's because they get that 30% bump up or whatever, that number that looks bigger. And this makes no difference. So for instance, they'll say, oh, we subtract a delivery charge and all that stuff. But you subtract it from the MRP, not from the charge you're actually getting from the customer, which again doesn't make sense. And then e-commerce firms had done this in the past, which is when they wanted to show gross merchandise value in their business. What they would do is simply get merchants to buy their own stuff. So, let's say I'm a merchant, I have a mobile phone to sell. I'm going to sell it as a mobile phone at 10,000 rupees. The e-commerce startup tells me, Deepak, you know what? Your mobile phone, I'll pay you 10,000. That's fine. But can I give a 1,000 rupee discount so that people buy it? I'll take the 1,000 rupee hit on my pocket. I look at this e-commerce startup and says, okay, thank you very much. I call up my wife and I say, you go online now, order this thing from me at 9,000. I will get 10,000 from there, we'll pay 9,000, we'll make 1,000 free of cost, and then I'll list the same mobile phone again. And I could keep doing this ad nauseum, right? So you have a massive GMV that has been created. Everybody's happy. The e-commerce company has lost a little bit of money, but it's investor money, they don't care. And they've created a valuation that is now 2x or 3x of what they earlier had because, they have GMV. And this cycle eventually led to, in one of these e-commerce startups, a company, one of the investors coming and saying, listen, no, you have to stop this practice because we can no longer, ignore that this is happening. Instead, what they started to do was then they said, if you're selling a mobile phone, please note its IMEI number on the portal. So when people get it, I can't see the same phone being sold again as the same IMEI back on the portal. So the idea over here is the GMV itself is adjusted, is a metric that is not required to be reported. You're required to report revenue. The revenue itself can be adjusted for certain things. EBITDA can be adjusted. WeWork started this community adjusted EBITDA, which is basically if I adjust for all my losses, I only have profits.
You've made me feel very cynical. But I think if I may take away the underlying sort of argument you're making is, look, there are some stuff we all agree on, accounting principles and so on, and let's use those obviously. But the moment we go beyond that into sharing adjusted numbers and all, the level of discretion involved is so high, as you've shared through all these examples, and the level of information asymmetry is so high that this is just not an exchange that should happen in the first place. I get that. But let me give you a counter example, which is that when, at least this is how I've thought of it, when VCs or early stage investors work with companies, they want the adjusted metrics. They work with you and they are in fact helping you come up with the adjusting metrics, or so I believe, because they're like, we want to see what is truly the potential of this business. So here's what my question is. Why is this okay for early stage companies or private companies for that matter? And why does it suddenly fail so spectacularly when you're talking about public markets?
This is interesting because I think in private markets, you don't get a report card every day of your numbers. You don't have people who can sell their shares in the first place. I think, the earnings multiples or sales multiples in private startups are much, much higher. I think today we just saw news that private companies in India, unlisted companies in India, are being valued at 30 or 40 times earnings. Not earnings, but revenues. So, which is like quite dramatic from when it comes to numbers, because no public company seems to be valued that much. So there's a reason for this. I think numbers are a narrative. And in private companies, they seem to be used as a marketing narrative. So you say that, listen, since you don't care about profits anyway, your guys are coming in for, potential. So I have to show you some potential numbers which look good. A recent time, a certain startup was dinged or was found out that because it was raising a round, and they figured that this guy had this particular founder had invented out of thin air certain workshops that they say belong to their their
Network
cohort or network or something like that, and they could only find it out by doing some kind of forensic thing when they went and checked each of the each of the places, and then they found some don't exist at all. Now the idea over here was that company could not raise unless it had this massive network. It invented the network so that it could show that it had this invented network. But think of some of the investors. Their interest is that this guy raises at a higher valuation. Let us just say that maybe it's a small thing. He had invented 3 workshops, just 3. It's not a big number out of 50. Now, if you're an investor in this business, there's no market value to it. He's going to go try and raise from another business. You invested at a $50 million valuation. He's trying to raise at a $100 million valuation. And you're thinking, listen, I could call this guy out. I've invested at a $50 million valuation. I put $5 million in. I might lose my $5 million because once he's called a fraud, nobody's going to give him money. Instead of that, why don't I just shut my mouth and stand here while he goes and raises that $100 million at $100 million valuation? When the money comes, I'll talk to this guy privately and I'll tell him to please remove all these false workshops from the business. Except you don't do that, because now the founder is almost like saying, dude, I'm the king. You are one old investor in my older fund. Kaun ho tum? He invents 30 workshops going forward and you don't have a say. Now, because you didn't stop him at the first time, you don't have an incentive to stop him now. So you end up in a private market where the incentives of the investors are suddenly become misaligned after they've invested in the startup to not demonstrate any frauds, because there's no getting out. You've written on a tiger, to get off it means everybody gets hurt. The public markets are not that kind. People can get on and get off at any time. If they get hurt, they know exactly how much they'll be hurt. They don't lose 100%. They lose maybe 30% or 40% because there's always a price. Because of that, public markets are far less forgiving of any of these things. And because public markets have seen this, they end up asking a lot more troublesome questions. Which is why companies like Bajaj Finance, which is listed, give you way more information than anyone asks for. They give you, my ECL provisioning divide into different categories of lending, my fees from IPO business, my fees from this, my fees from that. So they give you disaggregated numbers at various levels to allow you to understand how this business fares. And then once you start corroborating it with other people, you start finding, okay, these guys, you know what, they're actually big in this business. So for instance, if Bajaj Finance tells me that they've earned 150 crores out of the IPO financing business, and I look back at a quarter and I say, listen, you never raised any 7-day funding from the CP markets. Because if you don't, where will you get money to lend into an IPO market unless it's funded from a really short-term loan? And the only place you can get a short-term loan is not from getting deposits from people, or even banks won't lend you for less than 15 days. You do 7-day commercial paper. And that 7-day commercial paper, if it's not been done and this guy reports a 150, I suddenly get my blinkers on. But they did, the fact is Bajaj Finance tells me stuff that is valid because I can cross-verify it in these cases and so on. I think if you disaggregate, there is actually a much bigger standard over here. And the other part of this question, I suppose, is in the public markets, don't tell me that I lost 300 crores according to my accounts, but I actually lost only 200. You have a cash flow statement. Just give me a cash flow statement. Now, companies are not required to reveal it. Why did some of the IT companies in India get popularity in the early 90s and mid 90s also? Is that they started giving you cash flow and balance sheet statements when they only had to provide, according to the law, a profit and loss statement. They gave you all three so you could cross-verify numbers. And that was not being done because in India, everybody just kind of invented whatever the numbers they wanted and their auditors signed on it. Today, I think the other point is when you do such things, you find something strange. Amazon had negative earnings, losses for the longest time. Except in your mind, you're thinking, dude, Amazon, if it was losing money quarter on quarter for years, at some point it would need to raise money or take on debt. But the answer was no, it never did. How could a company that's losing money consistently quarter over 9 years not raise any capital? The answer was it was cash flow positive. So it was earning cash, but expensing out more than it had to. So to a certain extent, it was a shenanigan that worked in your favor. But they weren't doing a lot of this adjusted stuff, because you could see the cash flow statement and you could see exactly how the cash was actually coming back to the balance sheet. So that was what something was interesting was going on.
Okay. I think I'll go to my last two questions. So the first is, and I think you've sort of already hinted at this, how do I recognize whether adjustments, to the extent they're shared, are real or not? Or are you just saying the moment you have adjustments, throw them out? So that's my first question. And okay, why don't we go there?
Yeah. I think the idea of recognizing adjustments, whether they're real or not, first requires you to be very cynical about the numbers in the first place, because otherwise you'll believe them. So for instance, like I told you, if the receivables have gone up. Now, receivables going up is actually a complex problem, because it could be that the receivable is going up because the customer has said, I will pay you at the end of this project and you haven't yet finished, which is fair. It could also be because in India, there are, for instance, let us take a company that makes auto components. It's buying steel from a bunch of people, making its components and selling it to auto firms. The auto firms have no debt, but they're telling you, listen, we'll pay you, but on a 6-month cycle. That means you give me an invoice today, it will be paid after 6 months. For those 6 months, it's a receivable. You tell them, listen, I need to be paid by the end of the financial year. They say, don't worry, we'll pay you by the end of the financial year, no matter what. But if I look at the balance sheet on September 30th, I see a high receivable. If I see the balance sheet on March 30th, I see a low receivable. You go back and question, why does this happen? They need working capital through the year. Of course, I didn't know that, but the figures now start to tell me this thing. You talk to people in the business and you say, well, yeah, you know what? They do this. So sometimes they have to pay their suppliers. So then there is a financing arrangement that happens during this whole process. So when the financing arrangement happens, the company pays interest costs. So you look at this business and you say, well, you know what? You showed me the balance sheet on March 31st of last year. You showed me the balance sheet on March 31st this year. Both times you don't have any debt and you don't have any receivables. But somehow you paid 180 crores in finance costs. Excuse me, please explain. Now, once the guy tells you, listen, I have a problem. We've got this, working capital cycle that lasts me 6 to 8 months. I have to take loans in the middle, or I have to finance my receivables using factoring. The factoring costs are 24% a year, and therefore I have to pay some interest during this time. It's a rolling thing, but I need to do it. Otherwise, I won't stay alive. And my suppliers have to do this on the other hand, but they're not very strong. So sometimes I have to pay my suppliers before I receive the money from my customers. So I have working capital requirements, which essentially balloon up during the year and come down towards the end of the year. You would actually say this is okay once you understood it. And you can factor for it, saying, okay, listen, if this guy loses an order, he's finished because he's still got to pay his suppliers. He's not received his money. So that is one part that goes in. So the receivable parts and how receivables move through the year, that I think is one of the important parts. And SEBI should make it, in fact, the Companies Act should make it compulsory for listed companies to reveal both balance sheets and profit and loss statements every quarter. Right now, they require balance sheets to be opened only once in 6 months. That's April and September, alternate, only once in 6 months. But let's also go down another route and say adjusted EBITDA. If somebody says adjusted EBITDA, ask adjusted for what? Then find out what that adjustment is. If you're adjusting for cancelled orders, can you tell me how many cancelled orders do you have? And if you have 100,000 orders what percentage of them are cancelled, what percentage of the order value is cancelled. Can you tell me a little more, if the number is too high, can you tell me if these cancelled orders are coming from a particular geography or not? Because I want to know if someone's gaming your system or you're gaming your own system to show me this data, right? So you want to see that. Now, the last bit is, it's all a little bit more like common sense. Let's say a company says I have 2,000 crores of revenue. And addition to this 2,000 crores of revenue, I had 400 crores that I paid my delivery people as income per this thing. Now, typically, if you say, well, you know what, I know that if I make an order worth 300 rupees, the delivery charge is 40 rupees. So I know this because I deliver, or I use these apps for delivery for various things and all that stuff. Now, that means if I do 2,000 crores of revenue, roughly 10% of it should be the delivery charges. But here it's 20%. So are you paying the riders a lot more than what I am being shown as I'm paying? Somehow the economics don't seem to work exactly the way I'm seeing it. So this basically go on to a little bit of scuttlebutt. So for instance, there was a large textile company which has gone bankrupt, but this textile company did a certain amount of capex, and that capex was, let's say, I don't know the exact numbers right now, but let's say it was 1 crore rupees per spindle for yarn. It did some 1,000 crores or 500 crores or something like that. Then you'll ask other people in the business saying, what does it cost to get so many spindles, a new factory to do that? So they say, well, it cost me about 10 lakh rupees per spindle. You're like, wait, that guy has got 1 crore rupees per spindle. He says, dude, I don't know, maybe he's got spindles made of gold, but it doesn't cost that much. So now you're wondering why this because this is essentially shenanigans, right? So there are people who actually analyze balance sheets of companies and say, you know what, this guy has 5,000 people and his cost of computers is 500 crores. It sounds like he's giving everybody like the top end, the highest end of laptops, because the incremental new employees he's hired and the cost of this hardware that he seems to have bought seems to be he's completely way off the. So this concept of not making sense comes from experience, but also comes from talking to other people and understanding the business. But when it stops making sense, that things are off I'll give you the biggest example. If an IT company starts showing me profits of 5 crores per employee and their business is in IT services, I've been in IT services. I live in a city which has a lot of companies which do IT services, and we've seen those balance sheets. They earn maybe 30 lakhs per employee at the extreme. In terms of profits per employee that are on the project. If you get a guy earning 5 to 6 crores, what is he selling? Why isn't everybody else selling the same thing? If they're into IT services, then products is different. But that is the point. And if you're into IT services, you'll know this. But if you're a person from the outside in the investment world, you may not, So I think this idea of a shenanigan can come in from just applying common sense to various numbers.
I'd like to end with actually just a general public markets question. And this may not have to do with adjustments to earnings, but it does have to do with narratives around earnings. Let me call it a very superficial investor, because anyway, we're not allowed to trade. But in Indian markets, when I look at it, I see that there are companies with similar, let's call it, earnings levels. One of them may have a higher growth rate than the other. The balance sheets aren't way too different either. But the PE multiples and, in a sense, the valuations attached to them are widely different. I do see this fairly now and then. Similarly, if you take a publicly listed payments company that went public a while ago, got hammered down for the longest time, and the numbers haven't changed all that much, but there does seem to have been a narrative change or some metrics change, and suddenly this valuation has started recovering quite meaningfully. So when I look at this, I do feel that it's not all in the numbers, right? There is a very large element of explaining the numbers, or can I just go back to my, catch-all phrase, narrative around this, that changes how you value companies. Otherwise, how do you explain someone having a 70p, someone having a 25p, numbers not changing, but the stock price recovering 50% because of some understanding change? How do you help us think through this?
Yeah, I think it's a very reasonable question because nobody knows how companies are valued. Why do you value a company that's growing at 8% at 80 times earnings, and another company that's growing at 30% is valued at 30 times earnings? Although everything else is roughly the same: promoter earning, promoter holding in the company, debt levels are zero. Both of them depend on certain types of markets and so on. Then it's perplexing because we don't understand.
When I push people, they say, but the quality of earnings is different, but they can't tell me what that means.
Yeah, it's almost like my 100 rupees is better than your 100 rupees. But mostly it sounds, I mean, we've done this example a bunch of times, I think, in our recent town hall as well, where we talked about great companies, McDonald's, for instance, which was a fantastic company even in the 1970s. That company was trading at, I think, 75 times earnings. In 10 years, it was trading at 14 times earnings. The difference is it grew its earnings 3 times in the 10 years. That means 3x in 10 years. However, the stock price went up exactly 3% in absolute terms. Forget, not per year, just total absolute terms, the stock price went 3% up, which is a PE derating of a massive magnitude. But coming to, let's say, the payments company that we're talking, one of the problems in understanding this business was it said generated loans. Now you always look at a company and say, oh, he generated loans, he must be having NPA. Where is the NPA? The company says, well, we don't have any NPAs because we are not the ones giving the loans. There are other people giving these loans. Oh, no, you must somehow be responsible for these loans because you're originating them in your platform. Why should anybody give a loan? Then we're generating 10,000 crores of loans per quarter. And then you're like, okay, that sounds very high. That means you must be somehow funding it from your balance sheet. No, you're not funding it from your balance sheet. It's NBFCs that you go talk a little bit to the NBFCs and then they say, you know what, this guy gets me so many loans and nobody defaults out there, or not enough people default. And I'm willing to take that risk because I'm getting 35% CAGR, 35% IRR on these loans. And then, wait. This payments company is not taking any risk. No, they just collect the money. We pay them a small fee. The customer pays them a processing fee, and that's done. And then you're going back to the drawing table. Wait. The way I used to evaluate a lending business was NPA. That's why I gave this business no marks for lending because it wasn't telling me NPAs. It wasn't telling me XYZ. Now you're telling me that this is not a lending business. It is just an intermediation business, which is a very different deal because you don't have the risk. Suddenly, and then you're looking at those numbers at 10,000 crores and saying, well, it's a very big number. The problem with this is the narrative has moved from, it's a lending company, it is not giving me NPAs, so I don't like the numbers, to, wait, it's not a lending company at all. And therefore, so there is a risk, of course. There's a risk because even if you're not a lending company and you're originating loans, if the loans you originate turn bad, the lenders are going to stop working with you. But there is that risk, and keeping that risk in mind, you have to value the company meaningfully. In the sense, you've got to put that risk in your favor. But this narrative change had to come when investors were so cynical that they refused to believe anything management said. It took them time to understand that. Hey, even now, the model can change very quickly. Tomorrow, they might talk to a few other lenders who give them something else, and then they might say, oh, no, we're out of it. So the difference over here is simply that the narrative was not determined by the company itself, which is a very different thing than other places. Like, for instance, there was a company, and maybe I can name it. They were a large builder in the north. This guy used to come on TV with some tika and all sorts of things and, give gyan about how the business was. And very, very impressive personality. You would not, you couldn't dare question him. In fact, you would never question him about accounts because he was this, I'm
larger than life.
Larger than the accounts, my CFO will handle all the accounts business. So you, in the end, you were very respectful of him, and whatever narrative they wanted to provide, even the credit rating companies would tell you the same thing. They would say, you know what, he's there, no, he'll take care of it. Somehow we'll give them AA rating.
He'll manage it.
He'll manage it. It comes from the promoter's background and all that stuff. I think that kind of narrative is more dangerous because the narrative is generated by effervescence rather than substance. So when you create real narrative, when the narrative comes from the market participants who realize it, I think that has more value than when promoters push it themselves.
Well, thanks so much, Deepak. That was extremely useful. I'm never going to look at adjusted earnings again. And I think we started off there and I'm convinced. So thanks.
Yes, adjusted for all
For
the
everything,
noise.
I'm
We only have
profitable.
signals. Yes, there you go.
Thanks.
Cheers. Take care.
Well, thanks for listening. If you'd like to listen to more of our episodes, do visit capitalmind.in/podcast. And if you have ideas or feedback, then send them over to podcast@capitalmind.in. Looking forward to hearing from you. Till next time.